So there is a thin line between trading and gambling. It's entirely up to you to choose which path you want to take.
So what happens in return is emotions. Remember, you're the boss. At the end of the day, you find like you're in this emotional circle where this comes in, this comes in. But the good thing is,
we're back once again, and of course the name is Awesome Calvin the Entertainer. I'm right here with V Dollar once again. Man, how are you doing?
I'm good. How's it?
Pretty good. We got a lot of good feedback from our previous episodes. Now let's dig straight into it. I saw a lot of feedback that came in. I guess we shall start with that. In regards to feedback, people are saying, yeah, this is very good, man. They're saying it's always inspiring, you sharing with them. They're saying it's inspirational, very motivational. Could Daniel also speak more about the risks involved? I don't know whether you will start from that. But of course, most importantly for me, I wanted you to explain the importance of a technical analysis in forex trading. If you may start with that, then you'll probably respond to this person as well.
To quickly go over that, here's what happens. So whenever we are trading, we are dealing with data, currency data. So we call that technical analysis. You're looking at what happened previously to determine what's going to happen next. Actually, if you've seen those currency charts, say it's UGX or against a dollar or something, you're going to see the repetitive line graphs, right? So you're looking at what happened yesterday, because yesterday the Ugandan shilling could have gained value over the dollar, and that could again happen in the future. So using that to determine what to do next, when to buy or sell, is what we call technical analysis. It's pretty much easier, and every trader actually has to use technical analysis to be able to get trades and make money.
Interesting. The other question the guy is asking, you speaking about the risks
in trading.
involved. There is that fear of the unknown, just as expected.
Actually, that's something really important to talk about, because most people that talk about trading never talk about the risk. But what I try to bring out is, I want us to look at trading just as any other business. Each business has risks involved, and with trading, same thing. Because let me give an example. You could buy, say you bought the dollar expecting the price to go up, and in actual sense it goes down, and that means you're taking a loss, right? So at the end of the day, we have risks involved in trading. But now I want us to always look at, how do I minimize the risk? We actually have an extensive topic called risk management in trading. In actual sense, you know how much you're risking and how much you want to make. Let me quickly give an example. Say you could risk 50,000 UGX. In return, you're making 150. So you could easily say you're risking 1 to make 3, or you're risking 1 to make 2. So that's the risk side of trading. And I think it's really, really important to understand, because most guys come into trading and in actual sense they're gambling. It's like you're risking all your capital, you're trading capital because you want to make big. In other words, you're not thinking about the other side. How about the trade went against me? I'm probably going to take a loss.
So there is a thin line between trading and gambling, but it's entirely up to you to choose which path you want to take.
I think we covered it the other time. Trading without risk management is gambling. Because what happens is, you have two options. You're either buying or selling. So that's a 50-50% probability, right? And that means at the end of the day, if you're risking all your money on one trade, that's gambling, bro. You could make a ton of money, but then how about a trade goes against you? So risk management is key. Like, it's very, very important in trading.
Interesting. How do you minimize the risk then?
When we are trading, we have what we call stop losses and take profit levels. Well, these are just a bit slightly technical, I would say, but what happens is, whenever you enter trade, you know how much you want to risk, and we call that your stop loss. Let me give an example. So I'm trading with like 1 million UGX or 500,000 UGX, and I say on this trade I want to risk 30,000 UGX, right? So I'm going to set that order. It's a bit automatic. You'll have to just adjust that order, your stop loss. And what happens is, if the trade goes against you and it comes to the 30k risk that you intended to risk, well, the trade is going to close off automatically. And that means you risked 30,000. In turn, you wanted to make, say, 150,000, that being your take profit level. So just the opposite. So take profit level is much more of an automatic level. you're going to set, if say you wanted to make 150,000,
yeah,
you're going to set that order, and whenever the price hits that order, the trade will close off automatically. So there are two, and they're all important.
Yeah.
So you're going to use your stop loss, and then you take profit, and you're minimizing your risk.
Interesting.
Yes.
What are the key economic indicators to watch for, especially in forex trading?
Firstly, it's about the employment. Now, I'll give an example. So we do have an economic event in the US. It's to do with employment. They look at how many people have been employed, say in a month, or unemployed, either way, because if people are employed, then that means people are making money, you know, things are getting good. We actually have key economic events that tend to affect how currencies actually, you know, behave. We have one more called non-farm payroll. Again, that's based with the dollar. We have, you know, the CPI. Actually, so many. If I could give an example, I think looking at the bank governor, if he came up with a speech and maybe they're cutting interest or whatever, that's going to affect the Ugandan shilling. And in return, you either come up with either I'm going to be buying or selling. Yes.
That's quite interesting.
Yes.
Now, it takes me to another question. This actually came from our audience,
Yes.
especially the online audience. What are the best trading strategies for volatile markets?
Pretty interesting question. So to start off with volatile markets, these are much more traded markets. Like there's a lot of volume. Let me give an example of, let's start off, say, with something like gold. Gold is a tradable instrument, just like currencies. In actual sense, it's a currency because some people have their reserves in gold. They say, I have my 100 million in gold reserves, stuff like that. So these are much more of traded instruments, and that means there is a lot of volume. So firstly, to me, the very important thing that you need to notice is how has this currency been behaving in the long run. Let's give an example. Let's say the dollar has continuously been gaining value over the Ugandan shilling, right? And that means people have been buying the dollar. Like that's the very, very first thing. So in trading, we call that the trend. What's the trend? Is it on an uptrend or a downtrend? Yes, or sideways, where you find there's nothing happening literally. Like that's the very first thing. After that, you need to come down now with what we started off, what we call technical analysis. You're not getting down to the charts and saying, okay, we noticed people were buying the dollar, right? But which levels were they buying at? So you notice first thing that we started off with, the trend. Are people buying or selling? Because previously we talked about other traders. It's not only retail traders. We also have big banks. We have institutional traders putting in a lot of money into the market. So these guys tend to move the market. I mean, an institution could come in with like 100 million, and I mean, I'm trading with like 1,000, which is honestly not significant. So firstly, we have the trend. Next up, we could have our levels. Levels, as I mentioned, we could also call them supply and demand. It's just like how people buying this or selling it off, because you need that. And then after that, you're able to get your trade. Yes, so it's pretty easy.
So how do you determine the optimal position size for a trade? Position
sizes come down with your capital. I'll give an example. If someone is trading with, like, let's say $1,000, and then the other person is trading, say, with $100, those are two different accounts. And your lot size or your position size is much more of how much of that currency are you going to be buying. Let me give an example, one more. Say now I'm using 1,000 and I want to trade, say, the pound against the dollar, right? Yes. With my money, 1,000, I could be able to open up a bigger position size. Let's say one lot. A lot is much more of like a size, as I mentioned, when you're buying. On the other side, someone using $100 probably won't. What we can actually say, your lot size or your position size is much more directly proportional to your trading capital. The bigger the capital, more often, the bigger the lot. But please, let's talk about this also. So your position size is also going to matter when it comes to risk management. When you're using a bigger position size, you could make a lot of money, but then you're also risking a lot. You see? So at the end of the day, you need to use minimal position sizes that are going to make you money, and, you know, gradually. Now, what are the best ways to handle losses and maintain discipline in forex trading? I always mention this. I think the biggest thing that I've learned from trading personally is discipline, bro. Like being disciplined, and, you know, this is what I'm supposed to do and I must stick to this. So firstly, it's understanding that losses are part of trading. Yes, most guys come in and, oh, you know, I only want to make money. Come on, you need to understand that we have losses.
There is also a loss.
Exactly, like like how we mentioned earlier. So like that's the very, very first thing. Now the next thing is, okay, now I understand losses are part of trading, right? How do I minimize this? Okay, now that's why it comes down to risk. You know, I can only risk $10 to make this much. If you're trading with like $100, to be honest, I wouldn't expect you to risk 50. Like, it doesn't make any sense. You're like risking 50% of your capital because you want to make, I don't know, whatever. To be honest, no. And then lastly, we have what we call a journal. A journal is much more of like a notebook or something where you tend to write. I personally write a lot, and traders do. So you write down, you see, how did my trades perform? Did I make any mistakes and all that? So you correct yourself.
More like record keeping and
sort of, exactly.
How do you evaluate the performance of your forex broker? The intermediate, as you say? So how are you able to keep track and evaluate them?
I would say firstly it's the relationship between you and the broker. You remember how we mentioned, we said the broker is just an intermediate, so you're doing your deposit, your trades, everything with a broker. So the good thing is, on the trading platform, you have a history. You have all the trades that you've taken, you have almost everything. So you can always go back in time, say you want to preview last week. How did I perform last week? Because I would say much of the activity comes down now to the trader. The broker is just handling your dealings, your trades and all that, but then for the rest, it's down back to you. See, how much did I make? Because you can always preview all that information, all that data with your broker.
Now, what are the psychological challenges of forex trading, and how do you overcome some of these challenges, especially for a new trader?
Starting off with how trading is, I'd say trading is a business that comes down to you. In actual sense, okay, I would say traders are entrepreneurs, but this time around, handling their own business, no any other third party, no nothing. It comes down to you. You know, you want to make this much, you know, you want to risk this much. So what happens in return is emotions. Greed. Let me give an example. You could have made $50. Oh my goodness, I've made $50. I want to make more now, you know? Because remember, you're the boss. Like, no one is going to say, oh, Daniel, please don't place any other trade. So greed comes in. We have fear. Most guys will maybe actually have to fear of missing out on a trade, and then fear of losing money. So some guys will, oh, I want to make money, but I don't want to risk money. You know. We also have revenge trading. Revenge trading is much more like, say you've taken a loss or a losing trade, and now you're trying to revenge back to make back what you just lost.
What you just lost.
At the end of the day, you find like you're in this emotional circle where this comes in, this comes in. But the good thing is you can always come out with a solution, and we call that much more like a trading plan. You know, this is what I'm supposed to do. Again, it comes back to discipline, what we mentioned. I can only take one trade. Now let me give you an example. I've been trading for about 5 years, and at this point I only take one trade a day, and maybe sometimes I won't even trade. So
there are people who take multiple trades a day, and it's very risky.
We call it overtrading.
You want to make more money.
Exactly. Like guys feel like the more trades you take, then the more money, which is not true. Like recalling back when I'd started, like I would trade, say, with an account of about $30, grow the account to like 100 in a day. But then because I want to make more, take more trades, take more, and at the end of the day, I probably lost everything. So that's over trading, which is not a good, like it's the worst thing in trading.
Nice. Special mention goes out to Dim the Lights, Nadia, where we are filming this episode. I hope you're having a great time. You can always pass by in case you want a drink, a bite, name it. Now, as we wrap up today's episode, what is that tip that you wish to share with a trader who is just starting out?
All right, so trading is gradual, and I want all traders to look at how do I get better today and then tomorrow, than looking at it in a sense of, okay, I've started now and I want to like make big results today. And also totally understanding that losses are part of trading, and you need to now come out with a plan and say, this is how I'm going to approach this, right? Because like that's a non-negotiable in trading. You can't go over it. You must face it. Rather than trying to like, oh, I don't know, I won't do this. But in actual sense, at some point you have to face it.
Daniel, thank you so much for sharing in today's episode. We're looking forward to more on our next episode. I will see you next time, of course, with yet another exciting episode. Peace out.